Hey everyone, Scott Reinhardt here. And why should you care about the Fed? That's what we're going to talk about today. We're going to talk about the Fed's effect on your investments. So, thing we need to talk about is what the Fed has in their toolbox to affect monetary policy. We've talked a little bit about this, but let's talk just real high level what the Fed can do, and then we'll talk about how that might affect your investments. So, one tool the Fed has is they can lower interest rates. When they lower interest rates, that means that banks have more money that they can lend to businesses and consumers. It also means that businesses and consumers are paying less in interest, so they have more to invest in the economy. The second tool that the Fed has are bond purchases, which you will also see in the news, in headlines. You'll quantitative easing, or QE. That is literally just a fancy term for buying bonds with new money. That's what the Fed does. So what bond purchases do is it stabilizes the debt market and it creates new money. All right. So once again, what do these tools matter to you? Why does it matter? So when the Fed lowers interest rates, that means cheaper borrowing for businesses. When you own companies in the stock market, if you own individual stocks or you own a fund that owns a bunch of different stocks, many, if not most of those companies have debt on their balance sheet. Lower interest rates means they're paying less in interest, which means they have more to invest in the company, do research and development, create new products, pay their employees more. It's just better for those companies, which means it's good for your stocks. On the flip side, if you have bonds, when interest rates go down, bond prices go up. So even though it's paying out less in interest, in the short term, the prices will go up. So when lower interest rates happen, a lot of times that's good for both your stocks and bonds, or at least it can be. So now let's talk about bond purchases. Bond purchases, that's when the Fed buys bonds from banks and they create new money. We've talked about that in a previous video. So what this has done, especially recently, is it stabilized the debt market. This was good for investors because it put some liquidity in the market. It allowed companies to go out and raise money when they needed to at a really volatile time. And then obviously, when there's more money in the system, because remember, Fed is creating new money to purchase these bonds, that should mean that there's more investment dollars available into the economy. Okay, so you might be asking, well, all this sounds great. It sounds like the Fed should just keep interest rates low forever, and the Fed should just continue to create new money if all of this is good for the market. So now we need to talk about the trade-offs, because as everything in life, there is no free lunch. So there is risk involved with what the Fed is doing. One of those risks is inflation. All of this new money being put into the market definitely raises the risk that prices are going to go up here in the future. New money into the market means we need to see an uptick in production. And if we don't see that uptick in production, there's a chance that prices go up, because now all this new money has made our existing money worth a little bit less. So that's a concern. Asset prices. Some people argue that what the Fed is doing is artificially propping up asset prices, and it's creating a bubble in the stock market or in the bond market. It's not necessarily what we think. We don't think we're there yet, but that's a concern, that if the Fed just continually buys bonds, creates new money, backstops the stock market, people argue that stock market's getting artificially high, artificially propped up, and when that bubble bursts, it could be a disaster. So that's something we always have to keep an eye on. And then finally, the U.S. debt. When new money is created, that's creating more U.S. debt. So as the debt continues to climb, in the short term, we're helping the market, or the Fed's helping the market, but we might be hurting ourselves way down the line. So that's another risk that we're looking at. So Hope you learned a little bit about why you should actually care about the Fed and what effect it might have on your investments. As always, you know where to find us, carlsonfinancial.com. Give us a call, 844-CARLSON. Set up a time to discuss with an advisor. And until next time, have a